Welcome to the MUFG Global Markets FX Week Ahead podcast with Lee Hardman, Senior Currency Analyst at MUFG. It's Friday, 17th November 2023, and joining Lee to pose some questions on the financial market themes for the week ahead is Reza Nasehi, Vice President of the Japanese Client Sales Group for EMEA in London. The following podcast is intended for professional investors and eligible counterparties only, and not for retail clients. Any content should not be regarded as an offer to conduct investment business or an investment recommendation, but for information purposes only.
A very warm welcome to our esteemed listeners, and good to talk to you as always, Lee, on what is a cold but surprisingly dry Friday here in London. Lee, as of late, the momentum of the US dollar has been strongly positive since the dollar lows in July faded somewhat. And whilst the dollar began this week steady, having strengthened the prior week to almost fully reverse losses sustained following a weaker non-farm payrolls print on the 3rd of November, we've seen a clear reversal, the dollar under pressure, driving significant intraday moves, not seen since earlier in the year. Lee, what have been the main drivers behind this?
Yeah, hi, Reza. Obviously this week we have seen a big sell-off for the dollar. Looking increasingly likely now that we've probably seen the highs for this year in this cycle. And really the main driver for the kind of continued sell-off this week for the dollar has been the data that we've got from the US, in particular the release of the latest CPI report for the month of October, where we saw more clear evidence there that underlying inflation pressures in the US continue to normalize. Obviously, after COVID, we had upside surprises where supply chains moved inflation pressures higher. But we're seeing more and more evidence coming through now that situation has improved, and that inflation is now falling more quickly than the Fed and most people expected, and it gives us more confidence that inflation next year will move closer towards the Fed's target. So that's obviously having a significant impact in terms of expectations for Fed policy going forward. We are, and the market is a lot more confident now that the Fed has already ended their hiking cycle, and normally once the Fed is finished hiking, the next phase for policy is usually a shift towards rate cuts, and that's what we're seeing really. The market's getting more excited about the possibility of earlier rate cuts and larger rate cuts from the Fed next year, and that's the big driver really. That's pushing the dollar down.
Sure. Given the data this week, what's been the change in terms of expectation for those cuts into next year?
Yeah, like I said, the market is bringing forward the timing of the first Fed rate cut, so it looks like the market's now almost fully priced for the first cut of 25 basis points coming as soon as the May meeting, and then has moved to kind of price back in deeper cuts as well next year. So by the end of next year, there looks like there's now almost 100 basis points of cuts. So that is bringing market expectations more into line with our own view here. Our US rate strategist has been kind of out of consensus and has been looking for a sharper move lower in the Fed policy rate next year. He's looking for more than 200 basis points of cut. So if he's right, there's still a long way potentially for US rates to fall from here. And to us, that makes sense. I think if you've got inflation getting closer to target, and if we're right as well that we see US growth slowing more next year in response to higher rates, the Fed won't need to keep rates as restrictive as they are now, above 5%. And even bringing rates closer down towards kind of neutral territory at around 3%, to us, that will start to become a more compelling argument as we move through next year.
Great, thanks, Lee. It's worth you've mentioned the performance of the Great British Pound so far this year has been tightly linked to short-term yield differentials. Lee, can you tell us a little bit around, how the pound has been trading ahead of next week's fiscal statement?
Yeah, Reza, like obviously we've seen cable rise back up towards the kind of mid 120s. That's mainly driven by the dollar sell-off that we're seeing more broadly. But if you look at pound performance against other similar currencies like the euro, you'll see there the pound is continuing to kind of gradually underperform, where we've seen euro sterling hit fresh highs in recent days. And to us, that, like you say, reflecting the fact that yield differentials are still moving against the pound right now, particularly against the euro, where the market has moved to price in, similar to the Fed, earlier and more aggressive cuts from the Bank of England as well for next year. And similar also to the US rate story this week. The main driver of that has been the big downside surprise that we saw in the latest UK CPI report. Obviously, most people were expecting headline inflation to fall very sharply on the back of the drop in energy prices, but was also reassuring to see further signs of moderating inflation pressure for core measures and also the service sector. So all in all, it gives us more confidence as well that the Bank of England's hiking cycle is over. And if the economy continues to struggle to grow, like we've seen in recent quarters where it's been stagnating, the Bank of England soon will start to shift their focus as well to potentially moving policy into less restrictive territory. I know for now they're still signalling that they plan to keep rates on hold for an extended period. But we've already heard from the chief economist, Hugh Pill, recently, where he said that they could even be considering rate cuts, should I say, by the middle of next year. But for markets, they're getting even more excited and started to price in cuts during the first half of next year. So that's a reason why we still think there is room for the pound to weaken further against those crosses, such as the euro sterling cross. And that's based on the view that we think there's still room as well for the UK rate market to price in more cuts from the Bank of England as well, similar to the Fed, obviously with rates at a higher starting point. If inflation does continue to slow and growth remains weak, then there's also room for the Bank of England to cut rates more than the market's currently anticipating.
Great. Thank you for your time.
Thank you.
Thank you for listening to this MUFG Global Markets podcast. Rate, review and subscribe, and contact your MUFG sales rep for more information. Come back next week for more insights from the Global Markets research team.